Hey, Jim Schultz back with you guys for episode number 9 of the Greeks Crash Course. And in this guy, we are going to cover another one of our higher order Greeks, Vanna. This guy's going to be similar to, your charms, your colors, your Vammas. And so hang tight, buckle up, because things might get a little bumpy for these next few minutes. But we're going to follow the same process that we've outlined up until this point. What the Greek is, how we use it to improve our returns, and how we use it to decrease our risks. So without further ado, let's dive headfirst into episode number 9 of the Greeks Crash Course, Vanna. Okay, so what is Vanna? Well, guys, we're 9 episodes in at this point. You know what's coming next. We're going to do this mathematically. We're going to do this intuitively. So mathematically, Vanna is another higher order Greek. It is a second order Greek of the Black-Scholes option pricing model. And what it shows us is, how does delta change when implied volatility changes? How do changes in volatility impact delta? So in a lot of ways, it's similar to charm, because remember, charm showed us how delta was impacted over time. So here, Vanna's going to show us how is delta impacted when volatility changes. So it just gives us another unique perspective of this directional metric that we use all the time, which is delta. Okay, so what about the intuitive side of the explanation? Well, a lot of times when you break things down mathematically and then intuitively, the intuitive explanation is oftentimes easier to understand than the mathematical explanation. Well, that is not necessarily the case here with Vanna, and here's why. If we view things from the long side of the option contract only, here is where we want to start. Long calls have positive Vanna. Long puts have negative Vanna. Now, here's what that means. If implied volatility rises, it's going to send the deltas on a long call higher, positive Vanna. If implied volatility rises, it's going to send the deltas on a long put lower, negative Vanna. Now, on the surface, it might look like those are two different things, but they're really the same thing. And here's why. Okay, long calls, positive Vanna. Long puts, negative Vanna. Let's start with the long calls. I have a long call, implied volatility spikes. The deltas on that long call are also going to move higher because of the positive Vanna. This is because greater implied volatility, that literally means greater fluctuations in the marketplace. If there are greater fluctuations in the marketplace, there is now a greater likelihood that that long call might expire in the money. Do you remember how back in episode number 1, we talked about delta, and we talked about how we can use delta to gauge the approximate probability of the option expiring in the money? That's really helpful here to help us understand Vanna's impact. I have a long call with 20 deltas, IV spikes, it might move to 30 deltas. I have a long call with 35 deltas, IV spikes, it might move to 45 deltas. Now, similarly, long puts basically follow the same logic chain. Long puts have negative Vanna, but here's how it works. I have a long put that has negative 20 deltas. Implied volatility spikes, the negative Vanna is going to send those deltas down to minus 30. Or I have a long put at minus 35 deltas, implied volatility spikes, the negative Vanna is going to send that delta down to minus 45. So mathematically, my delta has decreased, but magnitudinally, the likelihood that my put expires in the money, that has grown. And that's the most important part of Vanna that we want to understand right now. Now, naturally, you might be asking, Jim, you're focusing on the long side. What about us as premium sellers? What about the short side? Well, we'll come back to that in a couple of minutes. Okay, so how do we use Vanna at? You guys probably know what I'm going to say here. Very similar to the other higher order Greeks, like your charms, like your Vammas, like your colors, like your speeds that we're going to see in the final episode of the Greeks Crash Course. This is not something that we actively monitor. Like, we don't have Vanna hedges just waiting at the ready to go off if things get crazy. Our Vanna kind of gets reconciled through all the other things that we do, through all the frontline activities that we deploy and all the protocols that we follow. And so understanding what Vanna is doing behind the scenes is extremely important to understanding what you've signed up for, all the gimmies and all the gotchas. But in terms of actively monitoring Vanna, it's not really something that we need to do, as you guys are going to see in about 45 seconds or so. Okay, so what about Vanna and increasing returns? Well, to answer that question, let's now complete the discussion that we started a few minutes ago when we were looking at the long only side of the option contract. Long calls have positive Vanna, but short puts also have positive Vanna. And the reason why that works out as such is the following. Puts naturally have negative Vanna. But if you step in and sell that put, then you then become positive Vanna. And the way this works is the same way it works when you multiply two negative numbers together. You multiply two negative numbers together, it brings you back to a positive number. So you take a naturally negative Vanna'd put and you sell that put, and you actually end up with positive Vanna. So now that we know that short puts are long Vanna, here's how this impacts returns. Short puts are naturally going to be three things. They're going to be long delta, they're going to be short vega, and now that we understand it, they're going to be long Vanna. If you catch a move in your favor, if you catch a bullish move on a short put position, that is very likely going to lead to very, very quick profits. And here's how. You're long delta, the stock moves higher, you're going to make some money. You're short vega and the stock moves higher, that very likely also means that volatility is contracting. You're going to make some money. But now we know that you are also long Vanna. That long Vanna is going to cause your deltas to shrink on that short put position, from 20 to 10 or from 30 to 20. But that delta decrease, it could help to contribute to sucking out the premium from the option in a similar way as to what we saw with Charm. So that is a pretty big gimme when it comes to the return side of Vanna. But not so fast, because our old pal Gotcha is right around the corner. Okay, so what about Vanna and risk reduction? Well, to better understand, or to best understand this angle of this Greek, let's make sure that we all understand something. We much prefer short puts as a standalone strategy over short calls as a standalone strategy. The main reason why is quite simple. The market wants to go higher over time. So consistently selling calls, week after week, cycle after cycle, year after year is just not a great strategy. So as a result, we are naturally going to be, most of the time, net long Vanna in our portfolios. Does this have some risk associated with it? Yes, it does. And not so much because of Vanna's impact in isolation per se. It's actually more of a compounding effect that Vanna can have alongside the other Greeks, the other higher order Greeks. So to illustrate this, let's suppose that my go-to strategy was selling 5 delta puts and holding them to expiration. Let's work through the charm impact, the Vanna impact, the color impact, and now the Vanna impact of that position. First off, your charm at 5 deltas, we already know it's going to be super strong, right? It's going to be great. Stock goes higher, stock even goes nowhere. That's going to be terrific. That's going to be a great outcome for you. We don't have to worry about that. Okay. Problem is, your Vanna at 5 deltas, it's going to be peaked, right? It's also going to be looking pretty robust. It's also going to be pretty strong. So you're already short Vega. If volatility starts to expand, that's going to hurt. But because of the super strong, super potent Vanna, that short Vega, it's going to grow and it's going to grow and it's going to grow. And so further expansions in implied volatility, they're going to hurt more. They're going to hurt more and they're going to hurt more from that peaked out Vanna. Now, color. You're holding this guy to expiration. What does that mean? You're going to have to absorb color's impact on gamma, which we learned is going to naturally cause gamma to grow and gamma to strengthen as you get closer to expiration. What does that mean? More moves in the stock against you are going to cause your gamma to grow. They're going to cause your delta to grow. They're going to cause more losses. They're going to cause more pain. All right. Now, lastly, as if it's not bad enough, now we have Vanna, which was great when the stock moved higher. It was great when implied volatility was contracting, our deltas were shrinking, and everything was fine. But now all of a sudden, implied volatility might be growing. The stock is falling, implied volatility is very likely expanding. So now what's going to happen? Our deltas are going to follow suit. Our deltas are going to expand, which again, the move is going against us. So this can mean more pain. This can mean more losses. So hopefully now you can see how Vanna can kind of be this contributing factor to, more pain and more hurt and bigger losses in the event that you are not correct. Okay, so naturally, you might be out there thinking, Jim, that does not sound good, man. Like, how do I stay away from that? Like, what can I do to avoid that situation? Well, it's actually pretty easily avoidable. All you have to do is two things. Number one, stay away from those low delta options. We've already talked about this in other episodes. We've already talked about this in other contexts. And here it is again. Those guys are not your friend. Number two, strategically diversify. Like, short puts are great strategies, and short puts will be one of the strategies that you use quite a bit, but they're not the only strategy. So strategically diversify into strangles, into straddles, into ratio spreads, even some defined risk strategies like vertical spreads, like iron condors, like calendar spreads. Doing these two things alone will help you significantly mitigate the negative effects of Vanna to the point where you don't even have to actively monitor your Vanna. And just like that, man, I can't believe it, but we are done. That was by far and away the hardest episode of the Greeks Crash Course that I had to record. I did a couple of those clips about 39 times that you guys, thankfully, will not have to see. But you made it through episode number 9 of the Greeks Crash Course. Vanna is in the books. Hey, guys, if you want to share this episode with one of your trader friends, that would be amazing. If you want to save this for future reference for yourself, that's also probably not a bad idea. And when you are ready, I will see you in the final episode of the Greeks Crash Course, where we're going to bring this whole thing home and tie it off with a bow and talk about speed. I'll see you guys there.